Where are we at currently in terms of your understanding of the market cycle, and what do you see as the next 1 to 2 years in the market?
So it's somewhere moderate. It's not a down and out, very, very attractive market like 2008 kind of thing where things are very, very cheap. We are not in even a March 2020 kind of environment. At the same time, it's a bubble about to burst or you should sell everything and run away. It's not that kind of a market either. Benjamin Graham said this decades ago, maybe 6, 7, 8 decades ago. He said obvious prospects for physical growth do not translate into obvious profits for investors.
What's one lesson from Parag Parekh that you think is the most important, be it life or investments?
Actually, if you ever come to our office, you will see it written at the entrance. It says equanimity, not genius, leads to success.
Going back to your analogy of what has happened in the past, whether it was airlines or it was telecom, do you think quick commerce could be the airlines or the telecom sector of the past? Hey guys, I'm happy to be a part of Zerodha's media network. Together, Zerodha and I plan to bring to you simple yet effective and impactful news and views from the best minds in the financial world. Hey guys, welcome to the Money Mindset. The guest on my show today is someone who runs a fund that is probably a cult favorite now for the last 10 or even 20 years, you may say. I have with me Rajeev Thakkar of PPFAS. Rajeev, thank you so much for being here on the Money Mindset.
Pleasure being here.
You know, this is one of the most awaited conversations because as I was saying, the fund that you run, the business that you run has become a cult favorite because of the kind of returns that it has generated. Stable returns through thick and thin, right? For the uninformed, I think the FlexiCap, Parag Parekh FlexiCap fund has given a return of 19% annualized since inception. Am I right?
That's correct.
Okay, and that is like a huge achievement because of all the ups and downs that the market has been through. So it's an absolute honor to have you here. And over the next 1 hour, I'm going to pick your brains about your investment philosophy. But first, tell me, how did it all start for you? You were telling me you started in the year 1994, so it's been 30 years of market, wisdom. Was it always ingrained in you, and how did your journey begin?
So, I would say it was the spirit of the times. So, a person pursuing a career today would typically join an engineering course, do a BTech, join a startup or something like that, do an MBA, create their own firm, do a fintech thing or a quick commerce, e-commerce kind of thing. That's the spirit of the time, the buzzwords that are there. My graduation year was 1992, and that was a period of the Harshad Mehta boom. That was the period where we were coming out of the financial crisis at that time. The budget from Manmohan Singh era, liberalization, FIIs as they were then called, coming to India. So financial sector was the place to be in for young people. Typically, doing what is popular does not work out very well initially. So that's what happened to me. Graduation year was 92, completed chartered accountancy by 95. Around 94, 95, joined an investment bank doing IPOs, and the market quickly crashed. Okay. So, like buying at the top in the stock market, I probably created a top in terms of the career, came into the field when it was probably peaking out in terms of IPOs. And so for next 94 to 2003, I was a jack of all trades. So I did multiple things in the financial markets. I did IPOs, as I mentioned earlier. I did corporate finance, which was raising money from banks for the company I worked for. I did bonds brokerage. I managed some fixed income portfolios for some clients and did various things. 2003 was when I actually joined the equity space, and then the equity investing career began.
So in 2003, you joined Parag Parekh itself, or did you have any other stint before that?
So the interesting thing is, I joined Parag Parekh PPFAS in 2001. Okay. I joined on the fixed income side. Okay. And in 2003, over a evening conversation, I mentioned that bonds seem to be peaking out and equity is very, very undervalued as per my view. So our founder said, yeah, makes sense. And by that time, we had a 11-year bear market in equities. 1992, the peak that we saw in BSE Sensex, that was not reached. So we peaked around 4,200 Sensex. March of 2003, we were at 2850 after 11 years.
Wow.
So people had just given up on equities. At that time, at PPFAS, we had a small equity PMS service, which had a corpus of less than 4 crores. So total assets under management was 3.85 crores or somewhere
Oh,
thereabouts.
wow. And today you guys are at 80,000 crores.
Yeah, total assets are around 1 lakh 5,000 crores, but equity itself is 95,000 crores.
Wow.
Plus.
Okay. That's been a huge journey, like an amazing journey.
Absolutely.
Okay, so tell me what then from there, how did it so you saw a huge bear market at that time till 2003. Post 2003, of course, things changed a lot.
Yeah, so 2003, the conversation that we had, which resulted in me moving to equities, is that the bond yields were continuously falling till that time. 1995-96, Government of India bonds were paying 14% per annum. And this fell to roughly 5% per annum. Now, when that happens, someone who's bought the bond at 14% will not only get the 14% interest rates, but the bonds will go up in price. So, debt funds of that era were giving returns of 20%. And equity markets 11-year bull run that I just explained. Because of that, you had equities which were giving dividend yields of 10%, and these are very, very well run companies, growing companies, and at that time dividends were tax free. Capital gains were taken away, so equity had zero long term capital gains tax. So it was a no brainer. So at that time, I didn't make a mistake of getting onto a popular asset class. I bought into a very, very undervalued asset class, shifted focus to equities. And that was, as you know, the beginning of a very, very strong bull run, 2003 to 2007. So what happens is when asset class is doing well, not only do your assets grow because of the appreciation in the NAVs or the portfolio values, but then people start allocating more capital to that. So equity allocations had fallen to very, very low levels. So now let's say Sensex goes from 3,000 to 21,000 by 2007. Even a 4 crore asset will go to 28 crores because of appreciation. Plus, when people see positive returns coming in, there's this huge stampede to invest in that asset class.
Correct.
So that's where the growth happened. So in the journey, there have been numerous crises at the market level, not at the fund house level. So we have had the 2008, 2009 global financial crisis. We have had the COVID period where there was a big downfall. We had the small jitters in between demonetization or GST introduction or some border tension with China or those kind of things, taper tantrums. So all these small crises came along the way. But clients saw that we have a stable behavior. We don't get carried away when things are going well. We don't get too despondent when things are down and out. And at that times, we actually try and pick up good investments. So people saw our behavior over time and gave us more allocations and trusted us with their money.
So your journey has been over the last 3 decades. You've seen so many cycles, right? Bear cycles, bull cycles. Where are we at currently in terms of your understanding of the market cycle? And what do you see as the next 1 to 2 years in the market?
So it's somewhere moderate. It's not a down and out, very, very attractive market like 2008 kind of thing where things are very, very cheap. We are not in a even a March 2020 kind of environment. At the same time, it's not that it's a bubble about to burst or you should sell everything and run away. It's not that kind of a market either. Currently, I see two segments, and which is true in most markets. There is a pocket which is overvalued. There is a pocket where things do not make sense. And there are pockets where reasonably attractive opportunities are available. overall we are at slightly above average valuation levels. So one thing people should realize is that returns will be moderate going forward. I don't know what will happen in 1 year, but if from a 5-year holding perspective, given the starting valuations being somewhat above average, and I don't see too much opportunity for upward re-rating of multiples. So the equity returns will largely be a function of earnings growth.
So when you say moderate returns, I mean your own fund has given 20% annualized in the last since inception.
That's
Is
correct.
that something that one can expect even in the next 10 years?
I would say not. So the returns can come from three sources largely. One is dividend return, which is either zero or positive. You can have earnings growth, which can be positive or negative. And you can have uh, re-rating or de-rating. So the multiples can go up or come down. Today, dividend yields are not significantly high, so they would be very, very low single digits. There's not much possibility for upward re-rating of P multiples or whatever metric you use, price to book or whatever metric there is. So the returns will largely be a function of earnings growth, which if we look at the nominal GDP growth uh, is around 12%. Now in some cases there would be equity dilution to achieve that growth, which will dilute the earnings growth further. In some segments, competitive intensity is going up. So we have seen competitive intensity in paints, for example, going up, in cable and wireless going up. We have seen competitive intensity in quick commerce and versus traditional big box retailers versus e-commerce, all that heating up. So when too many competitors come in, typically it has an impact on volume growth for individual companies and margins. There are segments where intensity is going down, for example, telecom, where you had maybe 7, 8, 9 players, that is largely reduced to 3 or 4 players. So it's not all bad, but one has to be selective and one has to moderate return expectations. I don't expect the past 10 years to replicate in future.
Okay, that doesn't sound very good, but but we'll take what we get. So you're saying on an average, moderate returns of around 12 to 14% is something that people should expect realistically over the next
That
few
is the
years.
equity return that comes over a long period of time.
Yeah.
In the past, when we were in a high inflation economy, because the inflation is higher, nominal GDP numbers have a slightly higher print. Now that inflation is structurally a bit lower, you should expect slightly lower nominal returns. Real returns are the same, but earlier you had, let's say, 7 8% kind of inflation rates. In those days, if you got a 6% GDP growth rate, then you could reach 14%, 15% kind of numbers. These days, nominal GDP growth rate is in the region of 10, 11, 12%. So one should mark down the equity return expectations.
Okay.
So what, let's say, bonds and bank FDs will give you 7, 7.5, 8. Now if equity gives you, let's say, even hypothetically 12, that's a 50% higher return than your fixed income securities. I think people have gotten too spoiled by the
I
last
know.
3, 4, 5 year returns.
Yeah, not far, 4, 5. I mean, even if you look at last 10-year returns in many funds, it's been over 15%. But I do know that throughout this period in the last couple of months, or actually last 6 months, you've been sitting on cash. Tell us, where are you currently? Have you deployed that cash, and are the cash levels still as high as 20%? If you can just tell us the methodology.
Sure. So our numbers come out and at the end of every month, and it's public information. Last we had about 22% kind of cash number. Now we just spoke about the different returns. So today, 1 year bank CD is giving roughly 7.6, and that comes with very, very low risk. Equity, assuming it gives somewhere around 12, and we don't know what that number will be, but let's work with 12 as a number, then you are giving up somewhere about 4.5% kind of return by being in cash versus equity. And this is only on the 20 odd % cash that we have. Remaining, of course, is
deployed.
in equities. Now, intraday movements many a times are more than this 4 to 5% kind of thing. So markets are very, very volatile. We are in interesting times where we have a very interesting precedent in the United States, and headlines are very, very interesting.
And no one knows which way it's going to go.
Yeah, there's this geopolitics and all kinds of things are happening. So we will wait for the right opportunity. So I like to give this cricket analogy to what game we are playing. We keep saying we are not in a 2020 game. So dot balls don't matter for us. We wait for not losing wicket is more important for us. We wait for a loose ball from the bowler and then we try to hit a 4. Again, not a 6 because then you risk getting caught out.
So the loose ball has not come yet, is what you're saying.
Yeah, it's slightly above average valuations. We are off the highs that we saw in 2024, but still it's not a completely down and out market. It's a reasonable market.
So you're saying that this cash level that you're sitting on, you're waiting for better levels, and that does that mean that you're foreseeing another bout of correction before the market gets to new highs?
I have no foresight. I have zero foresight. I have only 2020 hindsight vision.
If you don't have foresight, then I don't know what happens to all of us.
So the good part is that you don't need foresight to do good in investments. You can completely do without foresight. So let us say if you and I were running a casino and our slot machine was such that probabilistically we would win, the house would win. Now it doesn't matter what the next pull will be. Maybe the gambler will win or maybe the gambler will lose. But probabilities are such that repeated numerous times, we will come out better. We'll come out ahead. So that same process one can apply to investing as well. Buy when valuations are low. Buy with invest with well-governed promoters, managers. Invest in spaces where there's pricing power, competitive intensity is not too high. That's it. If the valuation is proper, you will make decent returns over the longer run. Now today when I have, let's say 80% investments and 20% cash, I am prepared for both kind of outcomes. So if market goes up anyway, I am invested in equities. If select companies come down, I am prepared to buy in a fall. Again, the entire market need not fall. See, based on news flows, you have seen the volatility which comes from various news flows. One quarter earnings disappointment, suddenly the stock gets sold off 5, 10, 15% in a very short span of time. We have, unless you have money, you can't take advantage of those opportunities if you are fully invested all the time.
But do you almost always have 20% cash levels, or is there any point in time where you deploy 100% as well? Just trying to understand the psychology behind, investing in different cycles.
Sure. So we don't always have 20%, but we usually have some cash. In March 2020, for example, we would have gone to maybe 1 to 3%. I don't remember the exact number, but very, very low single digits. Most times you would have around 5-6%. Right now it's above average in terms of cash holding.
How do you take that call? Because in March 2020, for example, I panicked. I know a lot of other people also panicked, and it's so psychological, right? How do you stay calm at times like this and deploy when everybody is selling?
Reading financial history helps a lot. There are these books like Devil Takes the Hindmost, which is a book on market cycles. There's a book called Extraordinary Popular Delusions and the Madness of Crowds. So all these books describe maybe 200, 300 years of market cycles, not just equities, across various things like the Dutch tulip mania, where people thought buying tulips at higher and higher prices was sound investing, and how that ended up. So it also, again, reading up on, let's say, the Great Depression in the late 20s in the US, that kind of gives you context. So the mental framework has to be built before the event. So just like you would have the firefighting equipment installed much before the fire actually happens, and you regularly conduct fire drills and the like, you have to have the framework ready, saying when something goes wrong, how well are you prepared to meet that thing. It also means that you keep aside some emergency corpus, so that in a downturn you don't have to first liquidate your existing equity investments. In the medical profession, they say first do no harm. So leave aside benefiting from a crisis.
Situation, yeah.
A lot of people had to redeem their equity investments because there were job losses in the COVID period, or some businesses just could not function. So restaurants and hotels and all had complete shutdowns. Airlines had shutdowns. People shed jobs. So now if someone needed cash flow to meet monthly expenses, they had no option but to sell equity at undervalued levels.
Correct.
So what one has to do is prepare for all these eventualities and build that framework that when things are very, very cheap, we'll buy no matter what. And when things are very, very expensive, we'll trim our exposures.
I think that is where your popularity also lies, in the fact that when bull markets commence, at that time, of course, your performance is good. But when there are bear markets, your performance is not as bad as perhaps some of the other funds, right? How do you manage that? How do you ensure that the losses are not as high, but the gains are disproportionately higher?
Yes. So a lot of people have built skill sets in terms of analyzing different sectors, analyzing the broad frameworks of companies, but they ultimately struggle in terms of what is the right price to pay for a particular business. Is this company a good investment at 10 times earnings, or should you pay 20 times, or is it okay to pay 100 times earnings? Now, these are questions people grapple with, and people get carried away by all the noise that is there. A simple framework to do this is look at the business as a whole, leave aside the current stock price. Say that these are the assets the company owns, this is the revenue that the company has, this is the profit the company makes, and based on your understanding of the business and growth prospects, you have some reasonable estimate of what will happen over next 5 years or so. How much would you be willing to pay for the whole company? And then there's no daily stock price up and down. Let us say you're buying the in our building there are shops downstairs. Let's say there's a electronic store. If the owner of the electronic store opened the books of accounts and allowed you access to do a due diligence, you see the sales turnover, you see the profits, you know how much the shop would be worth based on other transactions that are there. How much would you be willing to pay for the shop as a business owner? The same framework you have to bring to the listed equities. I think then it makes things very, very simple.
Okay.
That's where when you see, let's say for example, the
Can you give me an example?
I'll give you an example. Let us say in the late 90s, wonderful companies like Infosys and Wipro and all were trading at very, very high valuation numbers. Does it make sense to invest in those? If you thought like a business owner, the answer would be clear to you that you cannot buy these, and if you already own them, you should sell. So people may not have an intuitive understanding of this thing called P ratio, but when you reverse the ratio, E by P or earnings yield, that's when things become more clearer. So today everyone knows they can go to the bank and make a FD at 7.5% or 8%.
Correct.
If you are buying a stock at 200 times earnings, then earning is 1, denominator is 200. On your purchase price, currently the company is earning you 0.5%. Now for it to be equivalent to the 7.5% return that your bank is giving, the profits have to grow 15 times. 15x, not 15%, 15x. Then it will start earning a profit which will be equivalent to making a bank FD. And obviously, you are buying equity shares to earn better than debt returns.
Yeah.
Let us say your target is 10%, 12%, whatever. Now, to reach 12%, it will have to go up even further. So, here we are taking out the technical charts, we are taking out whether FPIs are buying or selling, what are the monthly SIP flows, all that we have taken out of the equation. Now, you are looking at buying the business as buying it as a whole. You are buying it and you are delisting the company
Okay.
at the current market price. Should you buy it? Then the answer will be obvious to you.
Okay. Can you give me an example of any listed company right now?
Right now,
Just for example, I mean, standard disclaimer, this is not a recommendation, it's just for educational purposes. Like a company
so
right now
that
which
becomes
looks...
challenging, but let me talk about a sector, and
Sure.
in the sector, all the companies are of a similar nature. And again, so going back to the Infosys example,
Yeah.
to break even with the bank FD, you need a 15x growth in profits. Maybe the company will grow profits 30x, 100x, in which case the purchase would turn out to be a sensible decision. So I'm not saying right or wrong, but you know how the odds are stacked up against you when you do that. So today, let's look at what are the most popular sectors that are there, right? Again, I am not commenting on individual prospects of the companies. Maybe one of them will do very, very well. In the future, they are able to execute very, very well. But today, the hottest space to come in is something like a quick commerce, right? Everyone is excited to sell you 10-minute grocery delivery.
yes.
You sit at home, take out your smartphone, order.
And most people
someone
are
comes.
addicted to it also. Yeah.
Correct. So there are two listed companies in this space. There's one which is
About to
based
be
on
listed
media,
also.
based on media reports, pre-IPO. So three, there's a Tata Group entity which is competing in this space.
Yeah.
There's a Walmart entity which is competing in this space. Possibly you'll have a Reliance Group company competing in this space. Some of the big box retailers are upping their e-commerce game, trying to shorten the delivery time, creating those delivery windows. Uh, Reported profits are not there right now based on the financials. So, from a business owner's point of view, would you buy these companies at 80,000 crores, 90,000 crores, 1 lakh crores, whatever the number is? Meaning, some people would say, yes, India is such a big country, such a big potential, and things will work out, and maybe they will. I'm not passing a value judgment, but I would not. I look for proven profitability. I look at reasonable valuation numbers where there is some cash flow coming to me as a shareholder. That's our framework.
But would you not buy into quick commerce purely because of even the competitive landscape changing so much? Is that a big factor for you to sort of take a decision call on investment?
So, a lot of people tell us, oh, you are into old school companies and you
Yeah.
don't buy the new age companies, and you don't get the growth equation and look at how much wealth creation has happened and things like that. Actually, if you look at our portfolio, we have overseas stocks which people would say these are very, very growth or new age kind of businesses.
And you were one of the first few funds that bought into big tech in the US.
That's correct. But when did we buy them? We bought them after they had started reporting earnings and after they had started throwing out cash flow, and after and once you could reasonably value them. So we were not investors in things like Google and Amazon in 90s when they were just being formed.
Fledgling companies.
Yeah. So we are not venture capital investors.
But don't you think, I mean, I don't know, correct me if I'm wrong, but don't you think that once these quick commerce companies start reporting profitability for a while, once newer players get listed, then the game will be sort of over. If the pie grows, as the expectation is that with the demographic dividend, the pie will grow and everyone will sort of, grow with it, don't you think the story will then be over?
So,
In terms of stock price movement.
this author, Nassim Nicholas Taleb, he says, if you want to read newspapers, I would recommend you to read old newspapers rather than today's newspapers.
Okay.
So, look at newspapers which are 1 year old, 2 years old, 3 years old, and then when you look at the headlines, you tend to laugh it off, saying, what are the kind of things we were worried about at that time, and what are the kind of things that were exciting us at that point in time. So, on social media today, on X, I was looking at some posts that people had made. They were talking about a company which IPO'd maybe 5 years back or 4 years back. So it was an old IPO. At that time, people were very excited about that IPO because it was in the credit card space.
Okay.
And at that time, credit cards were considered to be a growth sector, and how so much spend will happen and things like that. And
I
that
remember
company
that.
company has given zero returns
Correct.
since listing. Let me take you back 3 decades. A lot of your viewers may not have been born at that time, so it may be they may not get the context completely. But at that time, for domestic flights in the country, you had only one airline, which was Indian Airlines.
Yeah.
A new policy was announced saying private sector airlines will be allowed to fly in the country. Huge growth opportunity. You should have bought all the listed companies, right? None of those companies are around today. Not a single one. The most familiar name to people would be
Jet
Jet
Airways.
Airways, which went bust recently, but otherwise you had Air Deccan, Air Sahara, NEPC Airlines, East West Travel, Trade Links, Modi Loft, and
Wow, so
Kingfisher
many.
Airlines.
Yeah.
This is just a partial list. I
Yeah.
don't even remember a lot of the names now. Uh, at that time, MTNL and BSNL were monopoly telecom operators. Private cellular companies allowed to enter the space. Great opportunity, right? Bharti Airtel is the only listed company which has delivered some shareholder returns. Vodafone idea is around but
Yeah.
has not made
Disaster.
shareholder money.
Yeah.
Arcom shut down, and so many other companies shut down. So Tata Docomo and various other players shut down. So just looking at the volume growth, you cannot judge whether this will create wealth for shareholders. And
Interesting.
Benjamin Graham said this decades ago, meaning maybe 6, 7, 8 decades ago. He said obvious prospects for physical growth do not translate into obvious profits for investors. It's a very profound statement. There are of course other uh, new age things or things with good growth which have made money for shareholders. I'm not just giving one side of the picture. And we owned some of these companies in the past. So, for example, after the COVID crisis, we could see at that time that people are getting into more capital market activities and getting into financialization of savings and things like that. So things like depositories, things like exchanges
Yeah.
uh, were very attractive investment options. But there was not fierce competition over there. These were either monopolies or duopolies with very clear profitability in their P&L account, and none of this total addressable market and lifetime value and funny numbers, EBITDA excluding A, B, C and
So,
pre-stock options and
so
all
just
that.
going back to your analogy of what has happened in the past, whether it was airlines or this telecom, do you think quick commerce could be the airlines or the telecom sectors of the past? I mean, where, there are 10 people in the fray now, 8 people perish, 8 players perish, there are just 2 who barely make it through. And this is not not an investor's haven, so to speak.
So there will be quick commerce for a very long time in India. I don't think it's going away anywhere. And people are habituated, it's great for convenience and people will love it.
Yeah.
Does this have space for 10 operators? I have my doubts, that is one. Can I predict the clear winner today? I am not so sure. So telecom is a wonderful thing, right?
Yeah.
Cell phones have not gone away.
Correct.
We were starting to use cell phones in mid 90s. Today we can't live without cell phones. So we can live without a wallet with us. We can forget cash. We can forget our credit cards. But we need our cell phone.
But it's also because in telecom there was a big disruptor that came into the market as well. Like Reliance, when it came, sort of it changed the game of.
But do you know there will be no disruptors down the road in any of these sectors? Disruptors come all the time.
But then how do you decide? If you identify so, coming back to the next topic, which is mega trends, right? A lot of people ask, which is the big theme of the next 10 years? Where do we look at renewable energy? Do we look at generative AI? Do we look at, EVs? These are the buzzwords right now. What's your thought process on, say, these 2 or 3 sectors? And even once you identify a mega sector, a mega trend, then how do you drill it down to which is the company to buy?
Sure. So let's continue for a moment with
Sure.
telecom and quick commerce, and then we'll come to the mega trends and what do you do with mega trends. So if someone had the foresight that Bharti Airtel is going to be the company which will survive all this turmoil and which will deliver some returns, maybe it makes sense to invest in Bharti Airtel at that point in time. Was it very, very clear to me? Answer is no. And to most people, even for Bharti Airtel management, I'm sure there would have been very, very stressful times in the entire journey. So it's not as clear upfront as to how things will pan out and how to make money. And again, especially when things are in frenzy and valuations already factor in a lot of upside, then even if you get it right, your returns may not be that good, even if the company is the last survivor or last person standing in a tough marketplace. So I don't have any specific view on quick commerce, who will make money, who will not make money. I know that quick commerce will be here to stay. There will be maybe 2, 3, maybe at best 4 players which will be there in the market, but plenty of people will try their hand. And here I am saying not just the incumbent quick commerce, but even the existing big box retailers will up their delivery game in some form, and some people will try and disrupt the market as a late entrant. The existing players may not necessarily be the only players. So coming to the thing on mega trends, I think if one is watching media, then mega trends are very, very clear right now. What are the things that will impact the environment in the next 10, 20 years? Clearly, petrol, diesel cars will give way to EVs. When is a question? Will it happen in 5 years, 10 years, 20 years? But everyone is clear that transition is happening. Increasingly, renewable energy will play a bigger role as compared to, let's say, thermal or the fossil fuel related power infrastructure. Generative AI will be big in the future. In India, discretionary spend will be a bigger portion. So when a country comes from a very, very poor country to a middle income status, then a lot of discretionary items start getting consumed, and as people become affluent, people start spending on those things. So we are seeing, for example, things like travel or even things like sports. So like something like IPL, which has started recently this season, it's among the top sporting leagues across the world. So themes are relatively easy to identify. They were easy to identify even back then. So in the US, for example, you could see that auto is a big theme when cars were invented. It was clear, right? Why would you go on a horse or a horse buggy and not drive a petrol car? But there were, I don't remember the exact number, maybe 200, 300 companies competing or 500 companies competing in the auto space. Finally, only 3 were left of all these companies that were competing. That is the exact scenario today in China. While EV is a theme, you have hundreds of companies, hundreds of brands in China which are competing, and very few of them are making a profit. So when identifying a theme is easy, the second step is slightly easier thing to do is identifying who will lose rather than who will win. So when cell phone companies came in, if someone had some foresight, you could see that it will impact
Vodafone.
MTNL and
Okay.
BSNL. Because if people can talk on the go, why do you want to be restricted to a one fixed line phone that is there in a...
That disruption is something that you have to be able to
Yes.
figure
And
out.
now quick commerce is happening. Grocery stores, the kirana shops will lose. That is very, very clear to identify.
Forget kirana shops. I feel even e-commerce is losing out to quick commerce so much now. I mean, recently I do a lot of my, say, beauty, skincare purchases on Nykaa, for example. But now recently I've moved to Blinkit because they have another platform for beauty and skincare and it reaches your house in 10 minutes. So why would I wait for an Amazon or a Nykaa? So that's the kind of disruption. Now forget kirana walas now. Quick commerce is disrupting even e-commerce, right?
Yes. So identifying losers is relatively easier than identifying the winners.
Correct.
To identify the winner, it requires a lot of work and some amount of luck. Now, luck I don't mean in terms of showing your horoscope or doing palm reading or looking at the planetary positions. Luck by luck I mean probability. If you do 10 things, maybe 5 or 6 will work out very well and maybe 4 will not work out as you have anticipated. But the ones that you get right will more than make up for the ones that don't work out, because that is the nature of the game. If you put in 100 rupees in a stock, maximum you can lose is 100. But if it goes up 5x, you can make 400 as profit on that.
Correct.
So when you are investing based on your due diligence, based on all the work that you do, you need some luck after all the due diligence. So in due diligence, you check the balance sheet quality. That is very, very important. I'll give you an example. 2 retailing companies, traditional retailing companies, went into COVID. One came out, one did not. Right? So the one that did not had huge amount of bank loans. They could not service their interest and principal. They had to sell their brands and businesses to another large conglomerate. This is recent history,
Yeah.
2020, 21. So balance sheet quality is important. Can this company last a brutal period of competition? Management integrity and competence. So are these people just interested in lining up their own pockets, or are these people committed to making this work? So some of the fancied new listings, startups, there were some reports I was reading, and I am not naming the company. There are plenty of these listed, so people can guess about this. The startups the founders have been giving them a lot of ESOPs at very, very low prices, and they've been immediately selling. Now, if in the shareholder pattern, they are not the shareholders now, and looking at the amounts of money that they have raised by selling stake, they don't need money to run their household on a day-to-day basis. It's not that they need money to buy a house or to pay their child's school fees.
Yeah.
This is a very clear signal. They are selling stories to outside investors, but they themselves are not committed to owning stock in their own company that they are running.
This is recently what happened with.
So there are a few companies out there. I'm not tarring every company with the same brush, but if you are so excited about your company and if you think that the company is so good, why don't you figure as a significant shareholder in the company's list of shareholders? And those shares have been given to you close to free. You haven't even paid money for those shares, but the moment you are getting those shares in your demat account and moment there's no lock-in, you run out to dump those shares. So what kind of signal are you giving to the investors.
So you were telling us about the due diligence that one should be taking when you're investing in a mega trend.
So one is the balance sheet quality that I mentioned. Can they last a brutal period of competition? The promoter commitment, promoter competence, integrity, management integrity and competence matters a lot. And then you should have some on the ground understanding as to what are the customers really liking. So there may be four players who in a investor presentation will look very, very similar, but the customers may be voting with their wallets in favor of just one player, in which case it's better to invest in that one player rather than spread across
Interesting.
too many companies. So many of these businesses are winner takes all kind of businesses. There's no second prize. So
So to find that, to identify that winner is a tricky
is
one.
a very, very tricky one. So a popular movie, Three Idiots, had this dialogue. So who was the first person to land on the moon and who was the second one, who cares,
Nobody
kind
knows.
of thing. So it's very, very important to be in that one winner or maybe at best two winners, because the remaining people may not have much to talk about.
So in these four themes, large themes, where do you think there's maximum money to be made and where it will be easier to identify winners?
Tough in that sense, but in generative AI, from the way I am looking at it, having models is very, very common. So earlier people thought that US has a big lead, and then China surprised everyone with their own models and things like that. So creating a Gen AI model does not seem to be that much of a competitive advantage, but people who have distribution scale or people who can integrate that Gen AI into their existing products, those are the people who will largely benefit out of it. So the usual suspects in big tech already are email service providers or photo service providers or cloud providers. Now they will integrate these Gen AI models into their existing products so that customers can start using it. I think that's where ultimately the money and the pricing power will be.
Okay, interesting. Coming back to your investment philosophy, right? I want to talk a little more about behavioral finance and the kind of role it plays in your investment philosophy over the years.
So this is a very, very interesting subject, and maybe even 5 hours is very little to talk about it. One can go on and on. So please stop me if I don't stop.
No, please go on. I'm very interested in this subject.
So what happens is the finance that is taught in MBA or in CFA or other areas typically is very, very deterministic, saying predict the cash flows, work out the cost of capital, do a discounted cash flow, and if the DCF value is higher than the current stock price, then you should buy, and if DCF is lower, then it's overvalued, then it's a sell. But behavioral finance goes into the assumptions that go into the model. How do you know that this company will earn this much cash flow after 1 year or after 2 years or after 3 years? That's where the human psychology comes in. If we are analyzing a government bond, then probably behavioral finance does not have a role, because you can predict the coupon payments and the
It's very
maturity amount.
data-based, yeah.
Yeah, it's to the last decimal, you know how much you will
Correct.
get when. When it comes to equities, the assumptions that we make, will this company grow at 5%, 10%, 15%, 25%? All those are psychology related things. They are affected by things like anchoring bias. So, people have done this study and it's absolutely shocking. Let us say if some researcher came to us, that researcher asked you for your phone number and just to think about your phone number in your mind, and did the same thing with me. If your phone number started with a 9 digit and my phone number started with a 3 number, all the subsequent questions I would mark down because my mind is anchored to the number 3, which has no relevance to the question being asked, and your numbers would be higher. So again, a question, what is 5 multiplied by 4, multiplied by 3, multiplied by 2, multiplied by 1? Without calculating, just guess. This is a question given to one set of people. The other set of people are given a question, 1 multiplied by 2, by 3, by 4, by 5.
Okay.
Same 5 numbers, order has been reversed.
Answer is the same. Yeah.
And calculated answer will be the same.
Yeah.
Estimates will be wildly different because
Why is
the people who are given 5 by 4 by 3 will look at number 5 first. They will give a much higher estimate than the people who see the number 1 first.
Okay.
So there are things like anchoring bias, there are things like recency bias. So memory is short, as people know. So anything which has come on social media, print media, electronic media in the last 2-3 months, 6 months is something people remember. Anything which is 3 or 4 years old, people have absolutely no memory of that as far as decision making in investing goes, or even otherwise. So there is a thing called recency bias.
Can you give me an example of where recency bias has worked against you or for you? I mean, just an example to understand.
So in general, I spoke about, so everyone is excited about India growth story, volume growth and things like that. Everyone is excited about current IPOs, current headlines. No one remembers 4-year-old IPOs. So we try to hunt for ideas in 5-year-old IPOs rather than today's IPOs. So recency bias is something, framing effect is another thing. So let us say you are given an option, a coin toss. If you win, you get 100 rupees. If you lose, you get nothing. That is one option. Or you are given assured 50 rupees. Most people will choose assured 50 rupees. Similarly, if you are given a larger sum of money upfront and then asked to toss, if you lose, you pay back assured money. And if you win, you get to keep your money. Let us say the outcome is the same, 0, 100, risky, or 50 assured. But once you have seen that money which comes to you, you are given those currency notes, and then you have to give something back, you will choose a gamble.
Yeah.
So,
what bias is that you said?
Framing effect, how a question is framed.
So how does framing effect impact your investing philosophy or investing decision?
People use this all the time. So people try and, let us say a business is end of the day a classified kind of business. Newspapers have these classified advertisements. There's not much tech in that. Now, if a .com boom is going on, people will call that classified business as a tech business. Let us say a newspaper says now we'll publish classifieds online as well. Suddenly the valuation will shoot up because you are framing it in such a way. So people rename the companies that they run to make it more appropriate to what's in fancy right now. Or a direct selling business could be termed as a e-commerce kind of business, and you can
use it to your advantage, basically. So are you trying to say that all these biases, when you decide or when you choose to invest in a company, you try to make sure that you don't come under the influence of all these biases? Is that something that has helped you in the past?
Yes, absolutely. So another thing, now this is slightly controversial and people
I love controversial. Tell me.
People have strong opinions about this. So a few years back, 4-5 years back, ESG was a big buzzword, right? And framing in that context. So EV business will be seen as ESG,
pro ESG,
ESG, whereas a fossil fuel electric generation will be seen as non-ESG.
Correct.
A coal company will be seen as a non-ESG. Now, the electricity generated by that coal could be powering the EV
Correct.
end of the day. So, which is ESG compliant, which is not ESG compliant. So, sometimes because of these
But
labels,
that's a normal argument that EVs are not as environment friendly as we make them out to be, because eventually the electricity that is used is powered by fossil fuel.
eventually it will come from renewable energy. So,
Yeah.
that's
But
the
we've
path.
not reached that stage
We have
yet.
not reached that stage yet. That's correct. So, a lot of times because of this framing, something comes into fancy, something goes out of fancy, and which creates these valuation distortions. So, there is anchoring bias, there is framing effect, there is recency bias, then there is something called sunk cost fallacy. So, if you have bought something for 100 and that is now quoting at 90, there is a huge reluctance to sell it, even if you in your heart know that this is not rational, and from 90 it could go down to 50 as well. But because your purchase price is 100 and you have put money in that, or so that is actually loss aversion. Sunk cost fallacy is something else. Let us say you have bought a second hand car. Now, because you have put in some money, you don't want to send it to scrapyard, even if it's giving
So
a
you
lot of
keep
repairs.
chasing good
You're
money after bad.
Keep putting good money after bad, or averaging down. So,
I want to talk about that because there's a little confusion here also, right? For example, there are great companies that fall 30-40% in a bear market, but they're still great companies. So to give you examples, I mean, whether you look at a trend in the larger companies, whether you look at Keynes technology, whether you look at, I mean, innumerable companies have fallen 30-40%, Vari Energies, right? But these are super companies, good businesses, good promoters, everything. What do you do at a time like that? Do you keep the faith? What's the strategy?
sure. So, there are two kinds of people in the market. One is traders, one is investors. Traders have this very, very sacrosanct thing. We have to put in stop losses, and if it falls, we move on, because they, in fact, many times may not even know what the company does, and they are following some system in terms of either momentum indicators, technical indicators. So, for them, they should do whatever the system indicates. People who call themselves as investors, who have done thorough work when they bought it in the first instance. If the price has fallen without any change in fundamentals, most likely it becomes more attractive, where you need to put in money. But there are caveats to this. Let us say you bought it at 100 6 months back. After that, 2 quarterly results have come out. In those results, you can see huge increase in competition, margins have eroded, inventory is piling up, debt is piling up. Then, on a fundamental basis, you cannot say that I bought it at 100, at that time it was attractive, so it should still be attractive at 90, at 80, at 60. Your original fundamental analysis was wrong. You need to revisit that and decide on, based on current reported numbers, based on your estimate of the company, of the industry, is it attractive or not? If your analysis tells you it's a mistake, then don't look at your purchase price, exit.
But then don't you feel also in the market is such that prices drop and then reasons follow, right? So in such a situation, I mean, see, for someone like you who has all the resources, the teams, the intel, it's different. But for normal, regular retail investors who take a conscious decision of investing and then prices start correcting in a bear market where everything is correcting, at that point, what do you do? Like, for example, Trent, great business, right? I keep taking that example because it fell 40% from the top. It's still a great business. It's still in a market which is growing. Okay, there is competition, but nothing has changed dramatically in last 3 months for prices to fall so much. So, what do you do at that time?
So, let's leave out current stocks, for
Sure,
example. Let's go back to late 90s. Now, if Wipro and Infosys are trading at 300 times earnings or 200 times earnings, and they fall 50%, then they are still at 150 times earnings or 100 times earnings. That doesn't mean they are cheap. So, overall market has fallen 20%, but if something was 100 times earnings and has fallen percent, then it's at 80 times earnings. So if you have severely overpaid at the beginning, then a small fall will not make it very, very attractive.
Correct, correct. Interesting.
So another thing to remember is a stock which falls 90% from peak, a stock price of 100 goes to 10, is a stock which fell 80% first and then
50%.
fell 50%.
Yeah.
So just because
Yeah.
it's fallen a lot doesn't
Then
mean
it can't
it
fall
can't fall
further.
further.
Yeah,
So people buy bankrupt companies. So even after it was known companies are shutting down, people kept buying Kingfisher Airlines and Jet Airways and all that.
Yeah. So, a lot of young people watch our shows to understand how to navigate this market, right? These are a lot of first time investors who never had that experience or that wisdom. For someone who's just starting out in their 20s, they have, say, 20, 30,000 per month to invest through the SIP route, whatever, lump sum, anything. What would your advice be for them over the next 3 to 5 years? How do you reach your, say, first 1 crore?
Realize that you are going on a roller coaster. There will be severe ups and downs in the journey. To get more than what your PPF will give you, you have to be prepared to withstand the volatility. A 20-year-old will, retiring at 60, will pay money into their employees' provident fund account for 40 years. People take these insurance plus investment kind of policies and keep putting in money, not even knowing what that NAV is, what it is worth, or what kind of returns they are getting. Gold is purchased, put in the lockers, passed generation to generation. People buy their primary residence and stay in it for 30, 40, 50 years. In stock market, the minute you buy, you put it in a financial app and start tracking it minute by minute. Or if you bought a mutual fund, you track it on a daily basis in terms of NAV. That is very, very stressful, very, very harmful. If financial markets are not your day job, if you are a medical rep or if you are a civil engineer or if you are a lawyer, then focus on your profession, your work. Let the professional managers you have hired or let the index fund, if you have gone passive, let that do its work. Your job is to pursue your career, whatever savings are there.
So you're saying for a 20-year-old, 25-year-old, index funds is the best way to sort of
if they have
get
no
into this
idea of
market?
what markets are, then go with index funds. If you have some extra interest, if you can track various schemes, funds, go with diversified equity funds. Young people should try and stay away from thematic funds and trying to time entry, exit into small cap now, then mid cap, then banking fund, then now pharma fund.
Yeah.
Keep it simple, don't try and complicate it too much.
So one common complaint is that PPFAS doesn't have exposure to gold or hybrid funds, with gold, debt, everything in one fund. Why have you stayed away from gold?
So till very, very recently, our opinion was that sovereign gold bonds are the best way to invest in gold. So don't go with mutual funds. So one is the capital gains were tax free. You had no expense ratio. Plus you got 2.5% extra interest on that. So those have recently been stopped.
Yeah.
So maybe down the road we could look at something like a multi-asset or something. As of now, there are no plans for that.
Okay.
So largely our approach is to do fewer things and try to do them well rather than try to do too many things and not have that kind of focus. And you have very, very decent gold ETFs already in the market, so people can anyway buy those.
So tell me a little more about this, do fewer things and do it well, because I know that even as far as your strategies are concerned, investing strategies, you have a few strategies, but you do them, to the T. You get into the depths of it. Can you elaborate a little more on that?
Right. So right now we have schemes that meet three needs of customers. One need is cash flow management, very, very short-term cash flow management. So for that we have liquid funds and arbitrage. Uh, People in the higher tax brackets would choose something like arbitrage, other people choose a liquid fund. People who want regular cash flow or who want debt as a part of their asset allocation, for them we have two debt oriented hybrid funds. So here roughly 75% or 85% in that range of equity of fixed income securities, and remaining is in equity or REITs or those kind of products. So these are not very volatile products, and where they can do a systematic withdrawal plan so that they can get either monthly, quarterly, 6 monthly cash flow based on their needs, or they can let these compound if it's part of their asset allocation and if they are still in the savings stage. In equities, we have two schemes. This is for long-term wealth creation. We have the FlexiCap fund, and we have a tax saver fund, which to a large extent mirrors the FlexiCap fund. So there are plenty of common stocks across the two. Tax saver was launched because of that ATC benefit that investors would get, which they would not get in a FlexiCap fund. But otherwise, strategy is more or less the same.
Okay. So, you at PPFAS were one of the few people who started investing in big tech in the US when no one was investing. And then you rode that whole boom in whether it was in Google, Meta, Apple, etc. What's your worldview now about investing in the US? And as far as global diversification is concerned, would you increase allocation in your fund? Or do you think that now it's better to look inwards?
So firstly, a statistic which a lot of people get surprised by is that the India's market cap at the country level is a very, very small percentage of the global market cap. I haven't checked the number recently, but it's low to mid single digits in the global landscape. So a lot of giant companies, a lot of big companies are outside of India. That is point one. Secondly, even if you are buying Indian companies, you need to be aware of what is happening in the world. So all our IT services companies have markets in the US. All our generic pharma companies export to markets like US. Indian multinationals are owning big businesses globally. So Tata Motors has Jaguar Land Rover, which is a bigger piece than their Indian business. Hindalco has Novelis. Bharti Airtel has African operations. So anyway, you are a global investor today, and the whether a company is listed here or abroad, the dynamics are many a times the same. So if you are a tech analyst, if you are IT services analyst here, tracking Wipro, Infosys, TCS, you would also be looking at what is happening to Accenture or Cognizant. So anyway, you have to be a global analyst. In fact, sometimes by going abroad, you get better opportunities to invest in India. So if you want online travel aggregators, Make My Trip is not available on Indian stock exchanges. You have to buy it in a foreign country, or you can buy the parent of Maruti Suzuki in Japan, or you can buy the parent of Hyundai in Korea. Also, while Indian market is large and you have good opportunities here, some segments are absent here. So you don't have the Gen AI companies, you don't have the e-commerce companies listed here in a big way. So Flipkart is owned by Walmart. Amazon again is part of the global Amazon. Today, devices, if you buy an iPhone or Android phone, again, those are American companies which make the software. So some of these opportunities are only invested available abroad.
So what percentage of the FlexiCap fund is invested in global companies, in US-based companies? And what will the game plan be? Will it continue to be consistently there, or do you think you will raise that percentage?
So our mandate allows us to be invested up to 35% in global stocks. For a long time, we were investing up to 25-30% in global companies. In 2022, the industry limit got hit And RBI has a $7 billion cap for all mutual funds put together.
Correct.
So that was hit in 2022. It's not been raised since then. So we can continue to hold our existing investments.
But you can't
We
put
can-
fresh investments.
We can shuffle that, we can reinvest dividends, but we can't remit more money out. So because of that, the weightage has been coming down because incremental money gets deployed only in India. But today that percentage would be down to maybe around 12% or so.
So you don't think RBI will raise that limit?
So AMFI has made representations, but no decision has been forthcoming so far. So what individuals have been doing is they've been using their limits under the liberalized
LRS route.
remittance scheme, yes, LRS limits. They've been participating in global companies.
Okay. You never thought of investing in China through this fund? I mean, because that's also a common argument. I'm sure you've heard it a lot. Why doesn't PPFAS invest in China?
Yeah. So I've done a 1-hour talk on this. On your channel, I'm promoting my channel. So it's there on our on PPFS's YouTube channel on Chinese market and why you can't ignore China, but I've specified the reasons why we would not invest in those.
So briefly summarize. Distill it into,
To briefly summarize it, the most attractive sectors in China would be things like e-commerce, tech, EV, those kind of. So the Alibaba, Baidu, Tencent, BYD, those kind of companies one would like to invest in China, right? Those are prohibited for foreigners to own as per law. So you will say, but all these ADRs are listed. You can buy them in Hong Kong market. You can buy them in the US markets. Why don't you buy the ADRs or Hong Kong listed shares? These companies are shell companies in Cayman, which you are buying into, and they have no operating businesses whatsoever. So if you buy a BYD ADR, you would be buying a shell company, which is not the operating company. These people have a side agreement with the operating company, whereby some economic benefits would be shared in some based on some formula and some understanding. But these have no legal validity. And fun fact, Alibaba used to own a big portion of a financial services company called Ant Financial. And Yahoo, the global tech giant, was an investor in Alibaba through these shell companies. Alibaba spun off the financial services business without even telling Yahoo or leave aside seeking their content. Yahoo did not even know that this had been spun off for a pretty long time. Then they raised a hue and cry. They were given some very small amount, but essentially one division was spun off. Now, if this can happen to
a giant like Yahoo, who are we?
So, yeah, and again, sticking with Alibaba for a moment, Mr. Jack Ma was missing for a long time. China has had phenomenal GDP growth, but barring the recent sharp uptick, 20-30 year returns were either 0 or 2 or 3% per annum kind of thing in dollar terms. So while GDP has grown, investors have had a very, very tough time making money in that market. Of course, people like Berkshire Hathaway have made a lot of money on PetroChina, on BYD and things like that. But and again, that was led by Mr. Charlie Munger and his friendship with Li Lu and things like that. But so to make money in China, you have to be Li Lu. I don't think I have that capability to.
A lot of people, like recently, Mr. Vijay Kedia was on my show and he said that Chinese ETFs are a great way to participate in the China growth story. You wouldn't want to get there?
So I did a lot of work. I did maybe 6 to 8 months of intense reading on various aspects, which I summarized in that 1 hour talk. And I said, not my
not my cup of tea. Okay. Not my cup of Chinese tea, maybe. Okay, but very interesting. So, we've spoken about a lot of things, and I had actually opened the floor for questions from viewers, and I got a lot of questions across across different areas. So, I'd want to toss a couple of them to you, and you're free to sort of answer them however you'd want to. But I thought this would be a fun way to get our viewers to also interact, right? Okay. A common question that a lot of people have is that the fund AUM size is now 90,000 crores.
Yes.
When the AUM size becomes very large, outperformance is a bit of a question mark. What's your view on that, and how do you think you can navigate that?
Sure. So we are not a tiny fund anymore. That is very, very clear. I cannot pretend to be a tiny fund. Will I put 10% of my AUM in a tiny 1000 crore company market cap and move the needle at the portfolio level? No. At the same time, the AUM has to be kept in context. Our AUM looks larger than it actually is because we run limited number of schemes. So active AUM of larger fund houses is in the region of 5.5 6 lakh crores. The top 5 kind of people would have 4 5 6 7 lakh crore equity AUM active. Compared to that, our active AUM of roughly 95,000 crores is not that big. And the challenge is that at the fund house level, you have caps on how much of a company that one fund house can own.
Correct.
So you cannot split the AUM into numerous schemes and say, okay, now we have flexibility. The other thing I would like to point out is that the small and mid cap funds that are there among the larger ones, those are anywhere from 30,000-40,000 crores, 50,000-60,000 crores. Now, if those people are focusing on one particular segment of the market and running such large portfolios, we have a flexi cap mandate.
Correct.
So only a portion of our overall AUM should go into small and mid caps and not everything of it. So what this will result in is, in the small cap space especially, not so much in the mid cap, in the small cap space you will see some increase in number of stocks as and when the opportunity comes by.
Okay.
Will it be challenging to outperform? We'll see as time goes by, but you don't want to be a Ranji player throughout your life, right? You want to go play for the national team, you want to play in IPL. So
And anyway,
it's a
you've
good
given a
problem
disclaimer that you won't perform, give that 20% returns that we saw in the last 20 years.
That is
right?
true for everyone. I think any equity investor coming in expecting 20% return is likely to be very, very disappointed.
Okay, fair enough. One more question. Okay. What's one lesson from Parag Parekh that you think is the most important, be it life or investments?
So his lesson, actually, if you ever come to our office or whoever comes to our office will see it written at the entrance. So it says equanimity, not genius, leads to success. So in investing, not getting carried away on the upside as well as not being too despondent on the downside, that is what helps you navigate. Otherwise, it's a very, very volatile business to be in. So anyone who after a strong 6-month portfolio performance will go out and buy a Rolls Royce and in the bear market come down to a cycle and will do F and all the time is unlikely to succeed in this space.
But
Here
that's the thing with life also, right? Equanimity in life also helps a lot both ways.
Yes.
Yeah. Okay, that's a very, very helpful lesson. Which investors or thinkers have influenced you the most?
Plenty of them to name, and I'm afraid that I'll leave out a few names, but let me have a go. So globally, of course, Buffett and Munger are people we look up to. In India, we have followed Professor Sanjay Bakshi in terms of the detailed lectures and the frameworks that he puts out. But otherwise, people who have been successful in the Indian markets and who have had a very, very long kind of track record. So people like Mr. Prashant Jain, Mr. Sankaran Narain, or lot of private investors are there who will probably who don't appear in the limelight, so I'll not name them, but plenty of investors are there
Okay.
we track.
Fair enough. Index or active fund, what should be the preference and why?
So it depends on how much time do you have in terms of tracking what is happening in your mutual fund portfolio and things like that. So index funds are very, very simple in that sense. You can buy it and then you don't need to track what the portfolios are or who the manager is. Manager is effectively irrelevant in a index kind of context. So that is for people who are coming new. I think there are good managers in the country who have had decades long performance track record where they have done better than the index. There will be periods of underperformance for even in the best managers. So if you understand the process, if you are willing to live with some underperformance some of the time, then you could put money in with active managers as well. So it's end of the day an individual's choice.
Individual's choice. Okay, got that. Kindly ask if there is any possibility to launch a new fund to explore global opportunities like China, Europe, or the US.
Yes. So as we spoke in the earlier part of the conversation, the limits are there. Under the mutual fund umbrella, no fund house can put money abroad. We are frozen at Feb 2022 limits. The only people who are able to remit money abroad are people who would have redeemed some money or brought money back. So to that extent, they can redeploy it. Something which can work at scale is the liberalized remittance scheme, where people are buying ETFs, iShares or Vanguard or whatever else, or there are portfolio management services which are coming up from Gift City and other commingled funds coming from Gift City. So we are working on setting up our own Gift City fund structure. This is both for inbound, where foreigners wanting to invest in India, we will give them an opportunity to do so, and Indians looking to invest globally, for them also there will be mechanisms. So under mutual fund, answer is till the RBI permits, we don't have much leeway. Under the LRS route, there are
many options.
Yeah, there are options coming up via Gift City.
Okay, a few final questions before we wrap up. One, coming back to where we started, right? This is a bit of a volatile phase in the market. We've had some up days, some down days. There's so much uncertainty when it comes to what the Trump administration is doing. What is your worldview right now? And do you think the bottom is in place for 2025? Or, is it too hard to predict that?
Sure. So, a lot of brokerages have these nifty EPS estimates, Sensex EPS estimates. We don't track each and every company as part of the index, so I don't have a index view in that sense. Like we spoke in our conversation, there are segments which I think are still very, very overvalued. There are segments which are looking reasonably attractive. So I think there will be some differentiation down the road where you could have a scenario where the frothy stocks continue to drift downwards, whereas things which are attractively valued, they bottom out and they in fact start rising. So it will be a differentiated market is my guess. Again, no one knows for sure.
But you don't see this as being a protracted bear market like the one we saw in 2020 and in 2008?
2020 was not protracted at all.
Oh, actually, it was a very sharp V-shaped.
Calendar year 2020 gave positive returns, if I'm not mistaken.
Correct.
So the thing that I fear is that a big segment of investors in direct stocks as well as in mutual funds have come in the last 4 to 5 years.
Correct.
They have not seen a down market. Valuation wise, I don't see a reason for a very, very long bear market, but there's a caveat to that, in that sense that potentially supply is huge. So a lot of people want to raise money through IPOs, through QIPs. And again, a lot of new investors are untested. So what collectively all these guys will do, we don't have an answer to that. But I don't think we are in a bubble kind of scenario. I don't think it requires a huge downfall and many years of. So recently at one of the events, one person said zero returns in Nifty for 5 years. I mean, I am not in that camp.
Okay. So you don't believe that there's a big bull market coming, and you don't see a large bear market either. You think it'll be like cruising through over the next 3 to 4 years?
Yeah, as long as people's time horizons are long and return expectations are not way out there, people should do fine.
Okay. It was an absolute pleasure speaking to you. I mean, we've gone on, I think this is the longest that we've done, our podcast, but there was so much to talk to you about. And I'm sure we can do round 2 of this also. We have so much to pick your brains on. But I hope you enjoyed it as much as I did.
Yeah, thank you. I'll take the feedback. I probably should talk less because this was the longest podcast. And it was fun talking to you, Sonia. Thank you for having me.
It was a lot of fun talking to you. And, I always end every discussion asking people about money, because the show is called Money Mindset. And the people who come here and sit on this chair are people who have started from very humble backgrounds and today are not only created wealth for themselves, but for millions of people around them. So what does money mean to you? And how do you see your relationship with money evolve over the next couple of years?
So money is a means and not an end in itself. So people forget that. People chase money for money's sake. Money has only that much utility in the sense that it can give you financial freedom, give you an opportunity to do things that you like and love. So yeah, that's the objective. I work because I enjoy working, not because I get a paycheck. And creating enough savings enables me to do that, so that I don't need to every day wake up and worry about where my grocery is going to come from, or do I have adequate resources to meet my family's medical needs, for example. So yeah, that's what money is.
Okay, thank you so much. And from all your shareholders as well, me being one of them, thank you so much for the kind of returns, stable returns that you've given over the years, through thick, through thin. It's very hard to do that. And all the best for the future.
Thank you so much.